Hey guys, so today I want to talk about SoFi Technologies, ticker symbol SOFI. It's an online personal finance platform. I have a position in SoFi. It's not a small position, not a big position, just I think it's about 3 or 4% for me. So I just want to talk about it, and there's really three aspects of the business: the lending, the technology, and the loan business. So we kind of need to touch on all of them, and we can do some potential valuation. So what's SoFi? Like I just mentioned, SoFi provides financial products, including student loan stuff, refinancing, mortgages, personal loans, credit cards, investing, and banking. They're both the mobile app and desktop interface. The interest rate usually that they offer is pretty competitive. That's how they try to get new customers, and I'll show you that they've been getting a lot of new subscribers. And a lot of people utilize a money market for a little more long-term money, and the cash and savings at SoFi more for emergency funds. That's what I've been reading online. A lot of people do, and they really like that aspect of it. Some pros for customers, as in why do people use SoFi? Just reading the reviews online on Reddit, what people like it for. Well, they say the paycheck on direct deposit is always on time. They also have the 2-day early option, which you see a lot of banks doing now too, but you can sometimes get your paycheck as early as 6 days, which helps a lot of people because they need to get their check faster. People say a lot of great things about their customer service. Banking customer service is always really a pain. So a lot of people say that the customer service is really helpful. They send you, they have a lot of training, and they give you notifications to see, while you're waiting on the line. And you don't really have issues with your card if you need to go abroad. Some people also have issues, and they're really good in terms of the fraud checks, but it's not excessive. They also have the vaults. People say it's a good idea. They like to be able to visualize and set up the paychecks, and you can move around the different segments of how you want to kind of organize your cash flow, how you want to spend your cash, and you can kind of have it all set there so you can see kind of like a flowchart. And the relay is nice because it puts all the accounts together on the SoFi app, and so you can kind of see your network, and you can kind of track it as it goes higher, lower, hopefully not lower. A lot of people were also saying that they enjoyed the 3% cash back on the credit card, and then 2% after the promo. I think it might be even higher now, I'm not sure, but a lot of people were saying great things about the cashback thing. A lot of people use the SoFi card as a default fallback, because if you don't have like a specific promotion going on with another credit card, this is just like a plain percentage cashback that's just really good for everything. It's a very generic card. So most of their business is very bank-esque. They're kind of a bank, but they're not, because they have that whole technology platform. So when I hear bank, I don't really like the business too much, because it's just really hard to understand the business of a bank. The balance sheet is just crazy. The cash flow statement, there's a lot of items going in, a lot of depreciation, amortization. It's just really hard to understand what's going on, and it's not necessarily a business that everyone wants to be invested in, especially for retail investors. You kind of want a straightforward business. But SoFi is interesting because it does have the technology segment, and they're growing pretty fast. So most of their products and business is like a bank, like I just mentioned. The personal loans, home loans, savings accounts, and they have tons of products. If I'm not mistaken, they have almost like 10,000 different products, or thousands of products that they can cross-sell to different customers. So that's really good that they have that cross-sell functionality. They do have a technology segment, which is kind of the big thing with why this can be valued at a higher valuation. But it looks like, at least recently, the growth has slowed down a bit, but this might be temporary. So this technology segment includes things like Galileo and Technisys, which are both cloud-based core banking services that they can offer to other banks and stuff like that. So this has the potential to really kind of re-accelerate growth and generate a lot of revenue. So the projection for 2026 is 0.55 to 0.80 GAAP EPS. That's a pretty big jump, since I think they just recently achieved GAAP profitability, which is really big. But maybe they're gonna trim down some of the fat, and revenue growth is supposed to be pretty good. I'll be very surprised if they hit this. I'm not gonna lie, but management has been sandbagging so far, so that's a good thing. And that's only 2 years away, so that's a pretty high PE. Okay, so the projection, we just talked about that. The projection for the members now is insane. I mean, the number speaks for itself over here. You went from 100% year-over-year growth, and we're still doing 45% year-over-year growth. We're supposed to still increase like crazy. They have so many different products that they can cross-sell to these 8 million subscribers. So that's really positive for this business. You can make tons of money just cross-selling different products. They have thousands of these products, and that can save on the interest expense that I'll talk about later that potentially come. So one of the good things is that the marketing expenses decreased, right? So now that they have 8 million subscribers, you can kind of reduce. I think the reasoning for this decrease in marketing expenses, when you want to get a lot of customers, you have to market like crazy, market your product online, social media, different things like that, which costs a lot of money. So when you're in a hyper growth stage, which they're still in hyper growth stage, 8 million subscribers, you have to spend that money. And it looks like now they're trimming down some of that because they already have 8 million subscribers. So this reduced their marketing expense. That's really good, trimming down some fat. Revenue is also growing. I mean, I think Q1 year over year was 36% revenue growth. The home loan volume has increased 300%, right? So we're talking $90 million almost to $336 million in revenue for home loans. So that's pretty good considering the high interest rates. So the student loan volume is also increased by almost 43%, and that's a big thing, coming up with the student loan payback by the government. So that's all great. Now, some points: the interest rates are higher, so the total interest expense is double, right? It's not that worrying, right? Because 135 million to 263 million, so that's their total interest expense. But if interest rates come back down, on the other hand, the non-interest income will go up. So it'll probably offset any loss in interest income. So, you might have the interest expense go down, and then the non-interest income will go up. It's hard to say like in what ratios that'll happen, but I think this will probably offset each other, so it's not that serious. Another annoying thing is that the shares outstanding are increasing like crazy. I think a couple months ago they did another one for like $700 million of cash. But I mean, when you're still like in the non-profitability stage, hyper growth, you can do a few dilutions, but it's a little crazy, and I'll show you in a second. With the stock-based compensation and the increase of the float. But it seems like now that they're going to stop. Very recently, it seems that the trend for stock-based compensation and diluting shareholders is getting better, and at least they're GAAP profitable for now. So if they take care of that, I think they'll be okay. Okay, so right, so like I was saying, that shares outstanding number over here, it's almost doubled from 2021. It went from a little over 500,000 shares outstanding all the way to $1.04 million in shares outstanding. So that's pretty impressive. I mean, they've raised a lot of cash and also gave out tons of stock-based compensation, which I hate, but companies like Palantir, PayPal, a lot of other popular stocks, they also issue tons of stock-based compensation. But now that they're GAAP profitable, I think they're going to be reducing that and hopefully not diluting shareholders as much and issuing a bunch of shares to their employees. Okay, so EPS 2021 we went from minus 0.66. 2024 we're going to be at 0.07 analyst estimate for the fiscal year, and then in 2028 we're going to be at 0.83, which is the analyst estimate. Like we were talking about, 2026 the analyst estimate is 0.41, but management is guiding for that 0.5 to something EPS, so that's great. Revenue CAGR, we're talking this year analyst estimate around 17%. SoFi management guided around 15%, but management always sandbags, so probably somewhere in the 20s or high teens to beat that management target. So if we compound that all the way to 2028, we're talking about $4.3 billion in revenue. And if we assume kind of like a PE of 20, call that higher, lower, whatever, just kind of what I feel is personally fair. We're getting around $13 to $14 a share. Just very basic maths, right? So another way of possibly looking at this is through price to sales, and this is a very simplistic way of kind of valuing a stock, but I think now that the the EPS is so low, it's just barely positive. Price to sales can be another way of kind of giving context to the share price, given what it's done in the past. You can see that 2019 to 2023 ending price to sales. But I think by the like near the end of 2023, we had a price to sales of around 3.3, and maybe at the highs it was around 4.5. So according to management, the 2024 outlook of the lending segment will be relatively similar. So if we assume it stagnates, and we assume the guidance was the tech segment in combination with the financial segment is projected to grow by 5%. So, we 2023, $1.3 billion in revenue, and the technology segment plus the financial segment was sub $800 million. So if we do a little bit of math for 2024, given that 50% growth, we get around $2.5 billion of revenue in total. And like I said before, a lot of analysts are predicting 16, 17%, 20% plus growth. SoFi's guiding 15%. They're probably sandbagging, like I said. Pretty good. We're also guiding for 25% plus EBITDA margin. So the margin is going to be even higher, I think, once we churn down that marketing spend like I was talking about earlier, even less because we have so many subscribers now. And you have other expenditures that are associated with hypergrowth that you don't need to focus on so much when you have so many subscribers. Okay, so that revenue, I just pasted that in there for 2026, given those assumptions above. So if we assume, given those assumptions by analysts, we get around $3.2 billion of revenue in 2026. I think the price to sales around near the end of 2023 was around 3.3. So I kept that constant, assuming you thought that was a fair price to sales. And if it's 3.3 in 2026, given that revenue, we're talking about a $10.69, $10.7 billion market cap. And assuming we don't issue any more shares, which I think will be good given the fact that they have a decent amount of cash now, and they raised that $750 million, I think, not too long ago, we're looking at a share price of around $10.11. So let's just say $10. Right now it's $6.32. You're talking 50 to 60% upside, I think. My math's correct. So I think this is a decent opportunity. You're certainly speculating some of the math a little bit, just because if it's a bank, you value it more in the book value, and so that hurts the valuation a lot. But you have that technology segment, which is a big moat for SoFi, and cross-sell tons of their products. So it really depends on your risk tolerance, but I think SoFi could be a good opportunity 2-3 years from now. And I think this is an interesting business. It's a little complicated, but it has great potential.